I do want to talk a little bit about the dairy situation and outlook today. I think we've got a lot of different things going on, especially for producers up here in this region of the country. Milk production's been changing across the U.S., and I'll talk about that a little bit later. But really, we have to focus on a couple of other factors first. I thought maybe I'd provide a disclosure, at least initially, and that is, I've typically been writing an Outlook article for Horde's Dairymen, and I usually get the January edition. But this year, Corey Geiger had sent me an email. He's the editor there at Horde's, and he said, boy, my July person that usually does an Outlook can't do it this month. Can you fill in quickly? We'll change. And I thought, well, I could, but I only had a couple days to do this. And at that point in time, in the middle of the summer, we actually were looking at 2017 that had some recovering prices. And most of what we were hopeful for seemed reasonable because milk production was moderate across both the country here in the U.S. and especially in the world. That graphic that you can see on the Horde's Dairyman page sort of is showing you the major exporters, and you'll notice that they had increased milk production from negative levels on up to where we had a modest about 1% increase. Now these major exporters are 5 different country regions, including the U.S., but the countries included in that are New Zealand, the largest exporter, the European Union, about the same size, sometimes those two trade places in world exports. The U.S., 3rd largest exporter. Australia is the 4th largest, and then number 5 is Argentina. So that dashed line on there includes the major exports of dairy products from those 5 different regions of the world. As I said, we had some recovery that had happened both in prices but also production in the rest of the major exporting countries, and it looked moderate. So we were expecting that we would kind of be able to pull things off. But, since that time period, if you take a look what happened to opinions about future delivery, let's just take a look here in this example of the February contract for Class 3 and 4 futures markets on the CME. Back in August, all the way through the present time period, you can see that the opinion about those future prices for February milk declined from about $16 range down to the low $13 range. And that $3 drop in price opinions was really because we were seeing prices decline for lots of different dairy products, and we saw milk production increasing in the rest of the world. I'm going to give you a little sense for why that's important. And I'm starting with this at the front end of the discussion today because trade really is important. This blue line in the back of the chart here is showing you exports of dairy products on a milk equivalent basis as a percentage of milk production. So you can see that we started in the early part of this graph in 2000s with about 3 or 4% of our milk production being exported. And that 3 or 4% level was common for us. If we went back decades before that, we exported about 3 or 4%. It was a pretty marginal amount of product. But as we got to about 2005, things changed. And exports began to increase as a percentage of milk production quite a bit. And this is because world prices had risen to meet the U.S. milk prices, and we were suddenly competitive on this world market without subsidies or without anything else. And we began increasing that exports. That's been good for us in a lot of ways. It's allowed us to produce quite a bit more milk and find new homes for it because we weren't trying to sell it all into our domestic markets, but rather overseas as well. But I put the other line on here, the U.S. all milk price in orange, and that's shown on the right-hand axis, because I wanted to highlight for you that every time that we've had a major downturn in milk prices for more than the last decade, you'll notice that it was accompanied by a time when we were off trend on exports. Either exports had kind of leveled off or flattened, or they dropped and declined. So when we were unable to sell dairy products overseas for different reasons, we see that those products tend to back up into stocks here domestically. The prices have to fall, and when those prices fall, then our milk price is impacted. So that's the chain of events here. If we can't export as much dairy product, it stays at home. Those prices have to fall. When the prices fall, our milk price falls. So this is a bit of a double-edged sword. We're selling quite a lot more milk that we're producing in this country, but it has also impacted the volatility of our prices. And I think we ought to keep that in mind. You'll notice out here in 2016 and beyond, actually 2015 and beyond, that we've had quite a decline in exports. Not quite as much, but almost as much as we saw in the 2009 time period when we had such low milk prices. But it's been persisting for quite a long period of time. And we'll talk about that a little bit more later. So trade is important to us. As I mentioned, when we have products that aren't being sold overseas, it tends to back up into stocks. That happens first. People are reluctant to start changing prices of products real quickly. And you'll look at the graph here and look at that bottom line, the brown line. That was 2014. And I think that all of you would agree that 2014 was maybe the year in the dairy industry of perhaps a generation. I mean, it was a terrific year, great year for prices. And profits were strong that year. That was a year when we just didn't have a lot of extra product on hand like cheese stocks. But as our imports started to slow down going into 2015, you can see that blue line start to grow upward. Stocks are getting bigger. 2016, stocks are getting bigger. 2017, stocks are getting bigger. Finally, we've moved prices down to a point that we've managed to pull on these stocks some, and we're bringing them back down, but they aren't back down to the levels of the brown line or anything like we would kind of call happy day prices again just yet. So we've still got product to work down. You might ask, well, why was I so wrong in the summertime when I was talking about it? If you'll notice here, at this time period of about May of 2017 was where that graph in hordes ended. And it looked like we'd peaked at about 1% increase, and we're actually downtrending a little bit. But since that time period, exports from these major exporting countries has actually increased, and we're up at the point now where we're about 4% higher and climbing. And this is quite honestly entirely due to the European Union. The U.S. change in milk price or change in production is shown in the red line here. You can see that we're normally around 1 to 2% increase. We're down around 1%. So we are not producing a lot of extra milk in the country. But other countries of the European Union have been. And in fact, the EU is up about 6% in milk production with the last monthly report we have from there. And since collectively the European Union produces more milk than the U.S., that would kind of be a similar volume of milk as if the U.S. were up 9%, which we've never been month over month. So it's a really big increase coming out of Europe. That's why we've been in this long trough of prices. There's just too much milk production in the world right now for it to all be absorbed. I mentioned that stocks are important and they do overhang the markets. I showed you cheese stocks before, but in this graphic on the red line, I'm showing you the commercial stocks that we have of U.S. powder. And you can see that skim milk powder stocks for the U.S. have been increasing as well. So they're up to nearly 150,000 metric tons. The blue area in the background, however, represents not commercial stocks in the European Union, but rather the stocks being held by the EU themselves. They still have a policy in place that's similar to what we used to have with the Dairy Product Price Support Program, where the government, under time periods of low milk prices, was willing to buy dairy products off the market and hold them and then sell them back to the marketplace later. And you can see that the EU has really large stocks of skim milk powder. That's the reason that skim milk powder prices are really just low. They've dropped a long way over the last few years because there's just so much of this product out there, and we know that it's coming back onto the market. I would say that these intervention stocks from the European Union have gone into storage in 2015 and mostly 2016 time period. Well, those stocks are getting to be nearly 3 years old now, and while we can keep powder for a long time, it does begin to degrade. And I will tell you right now that cheesemakers who like to standardize their vats with additional protein sources would not use this powder in their vats, simply because it won't give them the kind of yields that they expect. It won't behave the same. So I suspect that a lot of this powder in the European Union is going to be coming back out for livestock feed at lower prices, but it will impact the sales of skim milk powder for some period of time. Here's what happened just in 2017 to non-fat milk prices because of these market stocks. They've gone from about $1 a pound down to that mid-60s range. They're actually up in the low 70s right now. But they've declined a lot. 30 cents a pound on powder represents a substantial ding to producers' milk checks. Good question I get from folks a lot of times is, look, why does everybody continue to produce under these circumstances, these low milk prices? And, you know, the reason is that the milk prices have not fallen down into the level where they don't cover all of the variable costs. Now, those variable costs are things like feed and maybe labor and electricity. Those are costs that we incur only when we milk a cow. If they're costs that can be put off over time or that we've committed to for a longer period of time, and maybe you can think about investment in a milking parlor that way. Even if we didn't milk cows in that parlor, we're still going to be paying on the loan for the milking parlor, and that's a fixed cost for us. So when price falls below into the variable cost range, then we tend to reduce milk production. That happened for us in 2009. Milk prices dropped so low that farmers were asking every cow in the herd, are you covering your variable costs? And if they weren't, we were culling pretty heavily during that time period, particularly in the West. We saw farms in California that didn't go out of business, but maybe they had barns that were only populated at 80% of capacity. So, you know, we reduced milk production because of those low prices, and that fixed the problem. We recovered from that. We're losing. We aren't covering our total costs of production, but we can do that for a period of time, and that's what's happening. 2009 was what I might call the deep cut, but this price that we've had has been below total cost of production for many producers, but it's persistent. It's just lasting a long time, and it's maybe more like the long, painful scrape instead of a deep cut. And one of the things that happens during these prices is that we just don't replace maybe some of the equipment and capital that we would want to and have been consuming. And you can't put that off forever. Those repairs begin to get to be expensive. We also have seen more recently this year that open accounts at some input suppliers like feed dealers and so forth are growing, and those are all signs of financial stress. So I think that we're likely to see milk supplies tighten up here this year. Let's turn a little bit and look at some other things. This slide is showing you the milk production per cow per day in the U.S. You can see the seasonal pattern there, the spring flush, March, April, May, when we get more milk on the market. We also tend to have a pattern that is providing more milk per cow every year. That's partly genetics and it's partly better management. But the genetics continue to accrue, and some years we just don't have a price that sustains pushing cows very hard, and so our production per cow tends to grow more slowly. That was certainly true in the 2015 year. 2014 you pushed cows hard because it was a great year to make milk, but 2015 we didn't do that so much. The latter part of 2016, we started having price recovery. In the first half of 2017, had big milk production growth, but you can also see the second half of 2017, that growth has been pretty small. It's also impacted cow numbers. 2014, that big market price it's a signal, and it's a signal that the market gives us that just says, we want more of your product, we want more milk. And so one of the ways you did that was by pushing cows a little harder. We got more milk per cow. But the other thing that happens, of course, is that we didn't cull as heavily. And boy, I know we had farmers that were joking about how many 3 titters they had in the herd that year, because milk was valuable, so you kept them in. And our herd in the U.S. grew that year. See the green line. The next year, 2015, it didn't grow much. It was pretty flat. 2016, the same thing. But again, with the modest recovery we were starting to get at the end of the year, folks were milking more cows, and that continued on into 2017 until the prices fell apart and cow numbers just leveled out again. So we've both got more cows, more milk production per cow. And, that's led us to this percent change in milk production. There's some variability here. This is for the U.S. on a monthly basis compared to the same month a year earlier. You can see there in 2009, we had negative change in milk production. We didn't produce as much because we culled cows more heavily. It's normal for us to have between a 1% and a 2% growth. We've been in that range for most of this last year, but we're getting down toward the low side of that now. And when we get down really below a 1% growth, now we probably aren't growing enough just to meet our demand in the U.S., our growth in demand for the U.S. milk production. That will help to lead toward price recovery as well. I want to take a look at this around the country. And, this is actually slightly mislabeled. This says the first half of 2017 compared to 2016, and it's actually for the full year, 2017 compared to 2016. There's kind of a diagonal band of milk production where we've seen growth, and that really goes all the way from New York to Minnesota down through Arizona and Texas. So through that diagonal swipe, we've seen growth in milk production. And, the Southeast has just been losing milk production for decades now, and it's not gotten much better. Georgia is the only state that's had some increases. Occasionally Florida does, but not too much down there. The thing that's different about this, I think, is looking at the West. Both California, when our number one milk producing state is down 2% in milk production, that represents a lot of milk production. And same thing with Idaho, our number 3 or 4 state. They changed positions with New York being down in milk production. This represents quite a bit of loss of milk out of the West. And when we look at home here, New York being up 2.5%, even Pennsylvania up a little bit, Ohio not up much, but 1%. Michigan is a state that's been on a tear here, and the state has doubled its milk production over the last 15 years. So they've been on a long-term increase. And Wisconsin up modestly, but modestly on the second largest milk producing state's a lot of milk. Let's go back and take a look at the previous year. This compares 2016 to 2015. Almost the same graphic, but not quite. You had a couple states in that diagonal swipe that were different, and states in the Northwest were actually up that year a little bit too. California, though, persistently down. In fact, if you take a look at California over the last 3 years, they're down the equivalent of about 6 to 7 million pounds of milk per day. That's one big plant that effectively the state of California is down. And indeed, we saw some information just a week or so ago where CDI is closing one of their butter plants out there, butter powder plants. I think the Los Banos plant. So California is adjusting to something that's not just a temporary trend, but probably a little bit more like longer term reality. And we here in the upper Midwest are adjusting to more milk in the region, quite a bit more. I'm not going to focus on Ohio because you folks have been growing, at a more temperate rate. But if you take a look at Wisconsin, Michigan, and New York, those are 3 states in the top 5 milk producing states in the country. Those 3 states have been collectively up 15 million pounds of milk per day over the last 3 years. That's 3 big plants. And we haven't had 3 big plants put in this region of the country. We've had some growth, some changes in plants for adding capacity, but not a lot. And in fact, Michigan's kind of the poster child for too much milk and not enough processing capacity. That milk has been spilling out into other states like your own, and certainly into Wisconsin, and it's put a lot of pressure on premiums for farm milk checks. So it's not just about the level of milk prices in federal milk marketing orders or the minimum prices, it's also about the premiums in our region. In contrast, I was talking with the CEO of CDI out in California, and he said they're starting to pay some premiums for milk, which they haven't done for quite a long time because they're short. This line, I guess, is just a way of showing that the northern tier of states is generally been positive, and the southern tier of states has generally been negative in milk production. And if we were to draw a line maybe a decade ago to say, where are we seeing a breakout, it would have been a line that would have been more north-south, not east and west. And we would have been growing in the west and modest growth or contraction in the east. So we've had some regional changes for sure in production. And I think that I could explain part of that by looking at some of this productivity that we've talked about. This graphic is showing you milk production per cow in the U.S. This is on an annual basis now, not monthly basis. But you'll see that, going back to 1960, we were at like 7,000 pounds of milk per cow. And today, our average is a little over 23,000 pounds of milk per cow. And this graph is almost linear. There's hardly any deviation from that trend over this time period. If you were looking at a change in corn yield or soybean yields, it would have been upward sloping too, but it would have had a lot more wiggles in it, some good years, some bad years. And with dairy productivity, it doesn't change very much at all. It just keeps marching upward. And if we look at individual cows, we've now got a handful of cows in the country that have produced more than 70,000 pounds of milk in a 305-day lactation. So, we have tremendous potential to continue growing this productivity. Whether we should or not is another question, but, I certainly think that it's genetically possible and with high levels of management could be possible. But I want to draw one other point to your attention, and that is that these cows, as they're moving up to 30,000, 40,000 pounds of production, are only able to do that because they're really metabolically active. They're standing at that feed bunk and gulping feed down and are producing milk at a terrific rate. But they're turning that into milk because they're very metabolically active, which means that they also are producing a lot of body heat, much like an athlete. And that body heat, I believe, is one of the big reasons that we're seeing the decline of milk production in the Southeast. because cows that are giving off a lot of body heat are just increasingly uncomfortable in hot and humid climates. And that describes the Southeast. So that's been a bit of a problem. I also want you to take a look at our top 4 milk producing states. And here we have California in the red line and Idaho in the yellow line. Those are the number 1 and 3 or 4 states, depends on where Idaho happens to be. And the green line is New York, the blue line is Wisconsin. Those are the number 2 and number 3 or number 4 states, depending on where New York is in comparison to Idaho. But I think you can see that these trend lines are very different. The line for New York and Wisconsin, and I probably imagine if I put Ohio in here, it'd look pretty similar too, has been increasing at a pretty steady rate and a faster rate than we've seen in the states of California and Idaho. In fact, the last couple of years, both Wisconsin and New York have been above milk production per cow in California, and that hadn't happened for about 68 years. So these are some very different trends that are occurring. Part of the reason, I believe, for this is that, you know, it's not hot and humid in California or Idaho, but it does get hot there. And at some point, cows can recover, you know, if the evenings are cool and dry. But, you know, at some degree of temperature and productivity on these cows, hot is still hot. You can tell some of that by looking at the monthly wiggles, the seasonal patterns in these lines. They drop from peak performance to trough in the western states is much bigger than it is for the cooler climates of New York and Wisconsin. So somehow physiologically, this region is just better for producing milk with our high yielding dairy cows nowadays. Let's shift to look at the ration value. The margin protection program has done this calculation for the ration to feed a dairy cow and its replacements for 100 pounds of milk. And you'll note that we peaked there in 2012 when we had both high oil prices that was competing for corn usage, but also a drought in that year. Since that time period, our ration values have declined quite a bit. They didn't go back to the pre-2008 levels, but you know, they're down around that $7 range. So there's been some relief there in input costs, at least. Not all input costs. Generally speaking, labor is more costly now than it has been in the past, but at least the ration value is moderated. I want to shift a little bit to looking at our domestic markets. Domestic markets are still, you know, 85% of our milk production. And so let's take a look at something that we call consumer confidence. This is a survey that's done every month, and the survey asks consumers how they're feeling about the economy. You know, they're asking about their personal experience in the economy. Well, pretty clearly you can see what happened in 2008 as we slid into the recession there of 2009, and we've been clawing our way back ever since. We're now above this level that we were at in 2008. So in general, the economy has been feeling pretty good to consumers, and that's a good thing. But we actually ask 2 sets of questions in this survey. One of those is, how do you feel about the economy today, and how do you feel about the economy in the near future? So this red line is exactly the same line that I was showing you. It's actually the average of the present situation and the expectations about the future. I want to draw this out just a little bit. So go back to that 2007 and 8 time period and look at the difference between expectations and the present period. When you ask consumers then, how do you feel about the present? They said, I feel great. Geez, my 401k has never been so big. You know, I'm actually spending money on some things. It's good. But you look at the green line and they would say, but I'm concerned about the future. We actually have a gross domestic product, a measure of the amount of income that we're generating in this country, that is about 70% dependent on consumption. So in earlier years, many decades ago, that number would have been much more dependent on things like manufacturing and less on consumption. But now it's based on consumption heavily. And what happens when consumers are worried about the future? Well, they get a little more conservative. Maybe they don't buy, a new car this year, or, a new flat panel television or something else that's a bigger expenditure. Maybe they don't go out to eat quite so often. And when you do that, reduce that consumption, start to be cautious with your money, that tends to push us into recessions. And that's exactly what happened in 2009. Oh, it was a little more complicated than that, but when you stop spending as much money, we are going into recession pretty quickly. Now, during that recession, things changed. If you look at 2009, 10, 11, even 12, consumers were saying, "Oh, it's terrible, it's horrible." Unemployment and banks are failing, and we've had mortgage defaults. But I'm optimistic about the future. And slowly we begin to pull ourselves up. I go through all of this explanation because I want you to look, since about 2015, what's been happening. Once again, we're getting this big divergence between our present situation and our concerns about the future. Now, I'm not saying we're headed imminently into the next downturn or recession, but I think that this gap tells us that we better be a little cautious, because when consumers get nervous, bad things can happen to the economy. But in general, our dairy sales have been strong. They've been good. Part of the reason is that dairy products have been a good buy. If you look at the Bureau of Labor Statistics, they put together an index of dairy products, and you can see that prices at retail in the grocery stores were the highest in 2014. Makes sense, because our milk prices were the highest. Since that time, they've come back down a little bit, and in general, dairy products have been a good buy. And that's reflected across most of our categories of sales. Some of these sales, though, like fluid milk, have just had other problems going on, and they've been tailing off pretty dramatically for us. And lest we focus on that and think that this has been a bad situation, let's take a look at the total milk equivalent consumption domestically here per capita, per person. You'll notice that that's increased, not every year, but mostly. Certainly the trend line's been up. We're at about 540 pounds of milk equivalent per person back in 1975. Today we're well over 640. And a big part of the reason for that is cheese. Back in 1975, we were consuming about 16 pounds of cheese per person. Today, the end of 2016, we're consuming about 36 pounds of cheese per person. So cheese consumption has gone up quite a lot. And at 10 pounds of milk per pound of cheese, that represents quite a lot of milk sales. We've had other categories like yogurts and things that have been up. So in general, I would say that our sales of milk domestically have been good. And of course, the population continues to increase in this country too. So we've had some pretty reasonable sales of milk. Let's shift back though and take a look at what I think is likely to happen globally. Fonterra, the major co-op in New Zealand, sponsors this auction for dairy products. The U.S. has a trader in that as well. It's Dairy America that sells product. And this product is of a known quantity. It happens every 2 weeks. So we know what products are going to be offered and how much. They open it up for bids, and they are going to reopen the bids and cancel the auction until the product is just exactly exhausted or sold. So this gives us a pretty good indication of what the value of dairy products are. And this global dairy trade index shows you that the world kind of had been in a tailspin through 2015 and 16, recovered in 2017, and had a bit of a downturn toward the end. But the last 3 or 4 trading sessions in 2018 here, we've seen an uptick. Now, I don't know if that's enough to call that a major trend yet, but at least it's moving in the right direction. Part of this is, I think, reflecting the slow milk production in New Zealand. It's probably going to be down about 2% this year for them because poor weather. They've had wet pastures early, and then they've turned completely around and had very dry pastures as a result of the La Nina effect that's going on. So some optimism here in the global dairy trade index. We've also had more problems trying to sell into export markets in the last few years because of a relatively strong US dollar. And the one other good thing I can tell you is that over the 2017 time period until the present, we've actually seen the dollar weaken a bit. That doesn't sound like a good thing, but it makes dairy products look relatively less expensive for countries that are trying to source them from the US. So a weaker dollar benefits us, and we're moving in that direction a little bit, at least over time. So that's also a positive for our exports. Just to talk a bit about price cycles. This is actually a cycle of the margin, the difference between the US all milk price and that MPP ration value. And I'm defining the cycle here as being the high point as a starting place, going down through some trough, and then we stop at the next high point before it starts to turn down. 2001 and 4 was the first of the cycles that I'm showing you here. It wasn't too bad. It was relatively short, 33 months, and it only declined to about a $6 margin at the bottom of that trough. The next trough was longer. It wasn't quite as low, but it started on the way down a little above $12 again, got to a low around $7 and hit its high up above $14. The next price cycle was the 2017 through 11 time period, and that was the one that contained 2009. Here you can see that in the worst part of this, we had an MPP margin that would have only been a little better than $2, below $3 for the worst of that trough. Now, there is no farm that I know of that's cash flowing at that kind of level, but it tended to be, in the depths of it at least, relatively short, although the entire cycle kind of persisted and dragged out there over nearly 48 months in time. 2011 was a little different cycle. It was almost as deep as that previous one, but this was deep because of high feed prices in 2012, not so much because of the low milk prices, although they were relatively lower then too. But it also took us right up to that nearly $16 margin at the end of it, which was 2014, and the feel-good year for us. Our current cycle, though, was around that $16 margin at the starting point, and it has drifted down to a low of about $6 for a couple of months in 2016, but the recovery has been modest and relatively flat. And I think that by the time we get through this cycle period and declare it ended, it will probably be the longest cycle that we've ever had, which is to say our downturn in prices is going to be, for some period of time. We've had some alternatives to producing milk, and that's culling cows. It was almost ironic, but during that year when our milk prices were so strong and we wanted to milk every cow in the barn, not cull them, our cull cow prices were among the highest that we've ever seen. Since that time, however, cull cow prices have not been great, and they've been declining down around that $60 per 100 pounds level. It's not been a great incentive to be culling cows out of the herd. And we also find ourselves with just so many heifers in the pipeline that we've got a lot of animals we could cull. So here's my price forecasts. I'm showing in the red line class 4 prices, the blue line is class 3, and the solid portions of the line are the actual prices that we've had. The green line is the US all milk price. The dashed area are showing you my forecast prices during this time period. So we're looking at a downturn in prices again from where we were just a few months ago in 2017. But then probably, well, I'm expecting at least an upturn in prices after the second half of the year. We're going to hit the lows in February, maybe March of this year, and begin to see price recovery. Although you can also see that I'm not expecting it to just break out into fantastic prices of 2014 either. These are modest recoveries in prices. In fact, I guess to summarize some of this, our relatively strong U.S. economy has been helping us consume dairy products. We've had tightness not only in the U.S. but the world in general in milk fat. Milk fat's kind of a luxury item, so when the economy is good, we're consuming more dairy product, more milk fat. But we've got an excess supply of milk proteins. Our powder especially has just been at low level values, and we either need to find new emergent economies that aren't consuming this as a luxury item, but rather improving the quality of their diet. That really describes where China was a decade ago. And if we could find that next China, then we can expect some of those milk protein prices to recover. Or alternatively, we're just going to have to explore our current demand for skim milk powder and move prices down, to clear these markets. And I suspect that that's what we're starting to do now. Our southern hemisphere of the globe is halfway through their production season. They have much more of a seasonal milk production than we do, largely because they're pasture-based. I'm talking about New Zealand and Australia, talking about Argentina and other exporting countries of the southern hemisphere. So their production season is largely scripted right now because cows are past the peak of their lactation, and they're just living with the pasture conditions that they have. The thing that's a little different for the northern tiers, we have more intensive milk production where we're not so dependent on pastures. And that describes not only the U.S. but also the European Union countries. And the EU is the one that's really in the driver's seat right now. If they slow down on milk production, we'll start to see more of the price recovery that we're hoping for. But unless circumstances change significantly for us on the export side, I think it's a little hard to be very optimistic about prices in the short run. I've got a forecast that looks at Class 3 being down about $1.35, Class 4 down by 85 cents, and the all milk price being down even more than that, $1.55. And that really is reflecting the declining premiums that we're seeing, especially in our region of the country. So basically, I think what we've got is a 2018 that's going to feel a whole lot like 2016 did in the way of both pattern and level of milk prices. Not very optimistic, I'm afraid. But I can offer you at least one note of optimism. I got one more thing to talk about, and that would be changes to the margin protection program. Judging from the level of buy-up on the MPP in the last year and the fact that farmers could drop MPP completely this last year, I don't know what the final numbers were from the sign-up, but I suspect that we've had very little involvement in MPP. But in the budget bill that was just passed last Friday, there were some major changes to the MPP program that was slipped into that. Most of them deal with the Tier 1 level, which is used to be the first 4 million pounds of historic production. They changed that, raised it to the first 5 million pounds of production, so we can cover more milk at the lower premium levels. And they changed the premium levels tremendously for Tier 1. They really slashed those to much lower levels. You can now buy the $8 coverage at 14.5 cents for Tier 1. They didn't change the premiums at all for Tier 2. We don't know yet for sure, but we will have a new sign-up now that will open it back up for MPP coverage in 2018. and it probably is going to be retroactive coverage back to January. But if they don't do that, then it will probably be a starting point of about March. But I want you to look at the current forecast for MPP that I'm showing in this graph here. It's showing you the first half of the year that would be below that $8 margin. And in fact, if we look at the net benefit, if you spent 14 cents to make that $8 coverage level on 5 million pounds of the tier 1, you could expect about a 26-cent net benefit on all milk production. So I think that this is something that's going to be hard for producers to ignore. That 14 cents is a really inexpensive option, I guess, to cover milk margins at $8 level. And even though producers, I think, were pretty well soured with the program in its previous incarnation, this is at least going to make it palatable to be thinking about this as part of your strategy for risk management. And we'll see how quickly that gets rolled out. But I think that USDA is pushing hard to try and get that implemented fairly quickly for folks. So with that, I'm at the end of my presentation. And Diane, if you guys have some questions there, I'd be happy to take a few of those.
Thank you very much, Mark. Opportunity for you guys to ask some questions now. Yes.
Back about 25 years ago, you had that dairy buyout. What effects did that have? How did that change?
Yeah, the dairy buyout, I've heard more about that being discussed. This is more of underground, kind of discussion. There's nothing that's been rumbling its way through the halls of Congress or anything else, but, there have been people talking about another buyout. If I had to guess, I'd say there's like a 0% chance of that happening. And the reason is we did have that experience back in the 80s.
You just disappointed some people.
Yeah, I'm sorry about that, but wow, that had such a short-term effect. I mean, it happened. It was really pretty expensive for Congress, to have the buyout and hold it, but it had an impact for about 1 year. And wow, because, we rebuilt the herd really quickly. And you really irritated your livestock producers. So I think that they would come out of the woodwork for sure, trying to oppose something like that happening. Plus, we have got so many heifers now that we didn't have at the time we did it before. I just can't imagine this being an effective program.
Do you anticipate any great changes because of the California federal order?
Well, the federal order has some news lately too. And that news is that there's been a Supreme Court challenge that is asking about the legitimacy of using the federal judges that they have used during federal order hearings. And so the federal order system is not willing to even allow the vote to occur until that Supreme Court ruling has taken place, which probably won't happen until June or July of this year. Now, should it be implemented, we don't even know what the final package is that they would be voting on, but we've got a pretty good idea about what it would be. My guess is that it's not going to change things a lot for California. I think we would see some shifts in what happens. I don't think that they would continue to produce as much cheese in California because there's not enough money in the pool out there to have those plants want to be associated with the pool. So the cheese plants would choose to depool. And if that happens, then slowly that allows a little bit more cheese production back here in these parts of the country where we're producing more milk now and certainly have a history with cheese. So our prices might come up just a little bit as a result of that Class 3 bump, but I think it'd be fairly modest.
Question: to deal with these low milk prices, what are your suggestions for producers to temporarily fix or remain profitable until the milk price improves? Not a biggie.
Yeah. I'd love to be a fount of knowledge about this, and I'm going to tell you the things that are only going to make you mad. This is this is a commodity that we're producing, and when you produce a commodity, the only way you have to impact your profit is to be the lowest cost producer. So you're talking about shaving costs. I would ask you, maybe if you've got small groups, go back home with a farm, with your employees. Sit down, have a meeting, and ask them, for their ideas about where do you think we can save a little bit? Where can we shave something? As I told you, I don't think that we're going to find lots of places to do this, but I do know some really good farms, excellent farms in 2009 that said they thought they had all the costs shaved out of a system, and yet they found some additional areas that year and said these costs are never going back into our production stream. So sometimes you can find a few additional things, but mostly I think it's, and I hate to say it, it's just going to be get down and find a way to get through this. It will get better. There's no doubt about it. But it's going to take some time. This is going into the 4th year, as you well know.
Do you anticipate coal prices increasing?
I couldn't hear the question clearly. Which price is increasing?
Coal cows.
Oh, cow prices. No, I don't actually. And the reason I say that is because our beef herd has actually been recovering, and they've got more animals. So they're even raising animals a little bit to heavier body weights because they don't want to take them in under the current prices that they've got. So I think we're going to have plenty of beef on the hoof, and I don't anticipate that cow prices are going to improve too much this next year. I don't know how it is down there for you, but here in Wisconsin, we've had some additional problems too. Because we've had enough more beef available, some of our dairy buyers, our cow buyers, have gotten much more picky about buying dairy cows. Their bigger bodies are just getting difficult to take through some of the existing plant equipment. And, they're either offering quite a discount on dairy beef, or else they, in some plants, haven't been willing to take it at all. So that doesn't sound real hopeful for cull cows.
I've heard there's some processing capacity being built now. You indicated Michigan, Wisconsin, and New York could support at least one more plant each. So who's building that? When is that going to come online? And how do you see that impacting markets?
Well, I'll start first with Michigan. Michigan is the state or the region, I think, that desperately needs processing capacity. They've been clobbered in 2 different ways. One is that, they've found that sending a lot of milk out of state, first of all, is really expensive for hauling, and that's, getting pooled back across producers' milk checks. And a lot of the times when that milk hits these plants over here, it's being sold at distressed prices or under class averages. So that has really hit milk prices. In fact, if you look at the all milk price, Michigan has gone from having, pretty respectable to, or even one of the higher all milk prices, to having the lowest all milk price in the country. So they need plant capacity. And they're looking at it. They're looking at a coalition of the co-ops there to invest in that, and also a proprietary firm. It will probably be a cheese plant, but I'm also going to tell you that we can't expect that plant to be online and taking milk anytime soon. It's going to be a couple of years before you get that plant actually built and functional. So that's not a short-term fix. We've had some capacity added, by the way, Diane, to a few of our existing plants, where they maybe have put in a different line or added some more storage or some other things that were a bottleneck in a plant. But most of that's been, pretty marginal stuff. Now, that said, We talk about capacity like that's a hard and firm number, but it really isn't. There are a lot of plants that maybe operate one shift a day or 2 shifts a day. Could you add another shift? Sure. You want to do that, when prices are where they are, you have to really ask, do we have a customer for the products we'd make? Nobody's excited about making more cheese or more powder or anything else if you don't perceive that you've got customers for the product that you'd make. So capacity is a little bit of a squishy number anyway.
Thanks. Last question. There's a lot of uncertainty around NAFTA. Has that been worked into the prices that have been projected, or if that does not go well for dairy, will we see lower prices?
I think we already have seen lower prices. So to some extent, I've worked that into my forecast, and I'm sure that the futures market has as well. When we started getting all huffy with other countries about trade and said we're opening NAFTA up again, one of the first things that we saw happen was that Mexico decided that they better diversify their suppliers. And so they started buying product from the EU and a little bit more from New Zealand. We're still their largest supplier, but we've lost market share just as a result of all of the saber rattling that we've done about trade negotiations. So even if we get a new NAFTA and it's favorable, we're probably going to see that it's difficult for us to build back that market share. With Canada, I wouldn't be really hopeful. They are going to fight tooth and nail to not really open their marketplace up very much. It'll be a tiny crack in the door, if anything. And I don't blame them. If I were in their position, I would be doing the same thing. But I just think that the realistic expectations are that that's not going to be a major source for us to start selling dairy products anytime soon. But trade's an issue. I also am concerned that, we decided very publicly to opt out of the TPP. And TPP is moving forward. That's that Trans-Pacific Partnership. That also includes our neighbors of Canada and Mexico. And it's entirely possible that Canada and Mexico could say, hey, let's just forget the U.S. Mexico, you want product, Canada would be happy to supply it to you at, preferred negotiations. That's not a good thing for us in the long run either.
Last question I have. Have you seen any trends in Midwest processors implementing production quotas for their farms?
When you say Midwest processors, I'm going to qualify that a little bit and say Midwest co-ops. We've seen most of our co-ops in the region send out letters to folks with at least the framework for reducing milk supplies or not being willing to pay full amount for milk supplies over certain levels. Most of those haven't been implemented, although some co-ops have implemented those plans already. With direct proprietary firms, we have seen a little bit of action. I mean, that was all the headlines this past April when Grasslands decided to just, without really any big warning, drop a bunch of farms that they had been buying product from directly. So yes, we have seen some of that, and yes, I do worry about it more. One thing I think that farmers probably should be doing, and I urge them to do, is to meet with your handler, whether that's a co-op or whether it's a proprietary that you sell directly to, and get a contract signed. It's common in most parts of the country to have that, but the upper Midwest, it's not been so common. In fact, we've just kind of had gentlemen's agreements, about sale of milk, but at the very least, I would want to have plenty of heads up if a plant didn't want my milk anymore. Let me have enough time to consider what my options are. Don't just give me a week or two.
Okay, last call for questions?
One more.
Right.
Mark, this change in the patterns of individual consumption of dairy products has coincided with the change in the population mix. Do you see any hope at all for increasing per capita fluid milk consumption?
You know, I would challenge your preface there a little bit. The ethnic group that probably consumes the most fluid milk in this country are Hispanics. And, you know, that's been a growing proportion of our population. But, you know, I think that most of the problem we've had with fluid milk has been the competition for that space. Nut milks have clearly eaten into that quite a long way. And just changing lifestyles. I mean, I'm going to be one of the first, I'm sitting here, so you can't throw tomatoes at me, I guess, from this distance, but I will tell you that it was common for me until maybe 10 years ago to wake up every morning and I'd pour a bowl of cold cereal and of course milk went on that. I don't do that anymore.
Yeah.
However, I do reach for a cup of yogurt every single morning. So I've been one of these people that's kind of category shifted my consumption. I don't drink as much milk as I used to, but I'm consuming more cheese, more yogurt, more butter than I used to. So, you know, I'm part of what I think the bigger pattern has been in the country.
Thank you so much, Mark. We appreciate you budgeting your time and getting online with us and sharing your projections and your willingness to answer questions. So thanks so much.